There's a couple of losses that relate to individuals. The first one says loss on sale of personal asset. This is the one I gave you an example of earlier. What does it say? It says, for example, that I bought that car, I used the car, let's say I bought a refrigerator for $1,000, and I used it, 5 years later, sell it at a garage sale for $100. So I paid $1,000 for it. How much did I get? 100, I lost 900. Can I deduct that? No, 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 why not? It is called consumption loss, personal consumption loss, not deductible. Let's say instead I bought that refrigerator for $1,000, but it's this rare 1947 Frigidaire refrigerator and it's now worth $11,000. I have a $10,000 gain. Government says, hey Raj, buddy, we're your friend. Guess what? We'll tax you as a what? It's not a business asset, capital gain. So the government says, you made some money? Come on down. You lost some money? Pobrecito, I'm so sorry to hear that. Gain on personal residence. What it says is if you lived in the house for at least 2 of the last 5 years. This is kind of cool. What it says is your gain is tax-free. No way. How much of it? Not all of it, but depending on how much you made. If you're single, $250. If you're married, filing joint, $500,000. $500,000. So that means you buy a house, live in it for 2 of the years, sell it, gain tax-free. Buy another house, live in it for 2 of 5 years, boom, tax-free. So that's what it says there. Basically, it says at least 2 of the 5 years. If you don't meet the 2-year requirement, but you're forced to sell due to a change in place of employment, health, or other unforeseen circumstances, a pro rata amount of the exclusion would apply. But otherwise, 2 of 5 years. It says the basis of stock received is a dividend. If it's included as income, fair market value. If it's non-taxable, then the basis is allocated between the dividend and the stock, kind of like a stock dividend. Installment sales method, this is actually shown up where they actually had you prepare part of a 6252. A 6252 is an installment sales tax return. But basically what it says is when you make a sale, but the problem is you're selling this asset. Normally you sell the asset, you have a gain, you get taxed on the gain. What it says is some of the proceeds are going to be received over several years. So you're going to get the money. I'm selling you a building for $1 million. You're going to pay me $100,000, $100,000, $100,000, $100,000, $100,000. That's installment income. Remember, one of the things we had as an AMT adjustment was the difference between accrual and installment when the installment basis was used. That was an AMT adjustment, but we'll cover that in another section, AMT. But what's more important is the following. How do you calculate it? Basically, here's what we do. It says applies to gains, not losses, but gains from the disposal of property where at least one payment is to be received after the year of sale. A portion of the gain is reported as each payment is received. Basically, what we're going to do is we're going to calculate the gross profit over the contract price. So the profit over the total contract price. That's your gross profit percentage. So in that particular case, that would be your percentage. So let's say, for example, it's 70 over 100. That would be 70%. That means 70% of every proceed received. Let's say I got $10,000. That means $7,000 would be considered a gain. It says, for example, Steve sells property with the basis of 80 to Bob for a selling price of 150. As part of the purchase price, Bob agrees to assume a $50,000 mortgage on the property and pay the remaining $100,000 in 10 equal annual installments together with adequate interest. The contract price is 100, which is 150 minus the mortgage. The gross profit is 70, and the gross profit percentage is 70%. Thus, $7,000 of each $10,000 payment reported is gain. Now, on the return, they ask you, you'll see here it says, what is the gross profit? So how much is our profit? How much is the contract price? So our profit is 70, the contract price is 100. Then it says divide those and come up with your percentage. Then line 21, how much cash did you get? And then the next one is how much is your income? So that's what you do. And then you enter it here and also enter on Schedule D or on Schedule 4797, depending on what is, what the property came from. But that's called a 6252 installment sales. Again, they've tested that before. That's why it's important to understand that. You'll see here, loss on deposits in insolvent financial institutions. This one came out of when all the banks, all these banks years ago were going under. So they said, what do we do? Basically, it says an individual who incurs a loss as a result of maintaining deposits in a financial bank that becomes insolvent or bankrupt may deduct the loss if it can be estimated as either a casualty loss on Schedule A or an ordinary loss on Schedule A, but part of your miscellaneous deductions, 2%, up to a maximum of $20,000. So that was Schedule A as part of casualty, or Schedule A part of miscellaneous. And again, this is something that came out of when all the banks were going insolvent. All right, let's look at this chart that we've set up here. It says, sale of personal assets. Losses, you don't get them. When does it apply? A person sells their house. Wash sales, losses, you don't get them. A person acquires stock within 30 days on either side. Sale to a related party, losses are not taxed. Gains are taxed. So if you make money, yay, we love you. You lose money, sorry, that's the dual basis rules. Like-kind exchange, you don't get losses. Gain recognized only to the extent of cash, boot, net debt relief, and unlike property. Involuntary conversion, how many years? 2, 3, or 4 from when? Careful, you get it from when, not when the loss occurs, but when you get the proceeds December 31st of that year. Installment sales, that's your 6252. A portion of the overall gain is recognized only as the person collects cash. So cash collected times gross profit over contract price. Sale of personal residence, what is it? Up to $250,000 if you're married filing joint. $500, you have to live in the house how long? 2 of 5 years. All right, that is property. In a minute, we'll do a bunch of questions to see if it all makes sense.